If you're like me, maybe you want to invest in EV stocks because you think EVs are going to gain popularity and get adopted more quickly in the coming years, but you haven't been able to find a good EV stock because they all keep going down. That's the problem that I've been finding. And so we're going to sift through all of these fallen EV stocks and figure out which ones might be worth buying today. So let's start with everybody's favorite EV stock, either favorite or least favorite, depending on who you are. And that's Tesla. I don't want to spend too much time talking about Tesla because, Tesla's such a popular stock. You can go anywhere for a Tesla analysis. But Tesla, I think, is one of these fallen EV stocks that might be worth a look. And the main reason is that Tesla is just the largest and most profitable manufacturer of EVs. So they have their gigafactories that are very efficient, that's vertically integrated so that they can do everything at a very, very good cost, as opposed to some of their competitors such as Lucid, Rivian, which have negative gross margins, and Polestar, which has just very poor gross margins. Even some of the legacy automakers can't really compete with Tesla. So Tesla stock has been down lately. Here's some news from today. It looks like Elon Musk took to X again to talk about some concerns he has with the company. So it sounds like there was a new compensation plan announced by the board, and Elon is not too happy about only having 25% voting control. It sounds like he wants more control, more voting rights. He says that the board is great. The reason for no new compensation plan is that we are waiting for a decision in my Delaware compensation case. The trial for that was held in 2022, but a verdict has yet to be made. So that's kind of crazy. It's been over a year, and he's still waiting for a verdict on this Delaware compensation case. So to me, this just sounds like company politics. Apparently, that's why the stock is dropping today. And before that, Tesla's been cutting prices, and there's been some concerns in China with competition. So I think all of those need to be addressed, but I think we also need to zoom out and look at the big picture. So before I go into the next stock, let's just look at Tesla and their financials, because really you can get all the politics and all the day-to-day news on any other news site. What I'm looking for is this a good stock to buy? So we can see that in the past year, the stock has done well. We had this massive rally, and then it sort of flatlined. So to me, I think that may present an opportunity, and here's why. So we see that Tesla's growth is falling. We can see that, they're growing year over year, but it's single digits. It's only 8.8%. Previously, they had some really, really high growth. Look at this, 51% year over year for the year from 2022 to 2021. So why is growth now slowing? I believe, and this is my opinion, my take, I believe that it's largely economic. And I think I said that in my solar video as well, but economic conditions really, really have an impact on Tesla. And that's because even though Tesla prices are falling, it's still a vehicle, and it's still an electric vehicle, and it's still expensive for most Americans. So most people are going to finance EVs. Most people finance vehicles in general. If you're going to buy a new car, most people are going to take out some kind of loan, and interest rates are still very high. So fewer and fewer people are going to be incentivized to purchase a Tesla because they're going to have to take out a loan, and they don't want to take out a loan right now. So that's hurting growth, definitely. And also, yes, we do have competition globally. In China, BYD actually just surpassed Tesla for the most EVs sold. So BYD is definitely going to be competition in China, but we don't have BYD here in the US. I believe BYD is only sold in China. So really that competition only for now is a factor for Tesla in China. Let's just look. Tesla, we know, they're a huge company. They have a very, very solid balance sheet. We see $26 billion in cash, which they can use to further grow the business. And we know that they are profitable because they're pretty much the only EV stock that is running a profit right now. We also see that Tesla has some future growth potential in autonomous driving, right? Their vehicles capture data every time they're on the road. And we know that Tesla is investing heavily in supercomputers and AI with their Optimus robot. So I think right now Tesla makes an attractive buying point. We can see here in my spreadsheet, Tesla isn't rated too high up, and that's only because of their low growth, and their margins are only in the 20s, which I would consider a minimum to invest in something about 20% gross margin. we see that their valuation is very reasonable, especially for such a large company. I mean, they have over 90 billion in annualized revenue. They're almost at 100 billion in revenue. Tesla is a household name. I think if you're looking for the best EV manufacturer, I think the case has been settled for a long time now. I think it's Tesla. I wouldn't mess around with these Lucid, Rivian, any of those, thinking that you're getting a deal, because really you can't compete with Tesla. If these other two, Lucid and Rivian, already have negative gross margins, they can't compete on costs. They can't lower their costs. Tesla has a nice 21% gross margin, which sure, it's low in the grand scheme of things, but for an automaker, that's very nice. Very, very nice. So let's move on. Let's move on to the next EV stock that I think might be worth picking up, and that is On Semiconductor. It's sometimes referred to as On Semi. That's what their logo here is. So onsemi, among other things, creates SiC chips, which stands for silicon carbide, and those are the primary chips that are used in EVs. The reason onsemi has been beaten down a bit is, it started when Tesla announced that they were going to stop using SiC chips. I'm not sure where things stand going forward on that, but whether or not Tesla uses SiC chips, pretty much every other EV manufacturer is going to use silicon carbide chips in some way, shape, or form. So let's look at this graphic here from On. This is just a picture of a car showing where SiC chips can be used in the car. It's everywhere. So they're used in the charging, they're used in the sensors, they're used in the power systems. Pretty much everything in the car in an EV in some way is going to need a chip, and a lot of those chips are going to be silicon carbide chips. So silicon carbide is a relatively new technology, and it's still gaining in popularity, but onsemi is the market leader in SiC chips. You can kind of debate. Some will say that Wolfspeed, ticker Wolf, is the leader in SiC. It kind of depends on who you look at, and that's changing all the time. But in these types of chips for EVs, let's say, onsemi is the leader. On has been, like I said, beaten down. If we look at their 1-year chart, they rose really, really dramatically, and then they fell really dramatically. This was due to an earnings release. They reported earnings, and their stock dropped 27%. I remember that day. They just are seeing the softening of demand that every EV-related stock has seen. So that goes back to my comment on economic conditions. We also have to keep in mind that onsemi doesn't just make semiconductors for EVs. Sure, that's a huge part of their business, but they're also involved in other areas that might require high-powered chips, such as robotics. So even if we see a slowdown in EV demand, maybe we'll see a pickup in robotics demand. Again, we have to look towards the future a little bit. We can't just look at every day today and say, oh no, it's slowing demand. We kind of have to use our best judgment and say, well, these are chips that are going to be used in other things, not just EVs. And when the economy recovers, we should hopefully see a demand for EVs to grow. So we say that this is a $32 billion company, so quite a large company. We see that they're very profitable. Look at this nice big yellow bar here. So they are operating at a profit, unlike Wolfspeed, and that's kind of why I'm leaning more towards onsemi as opposed to Wolfspeed as an investment. We can see that the revenue is flat year over year. Again, that's due to the slowing demand in the EV sector. But look at this. Even though their revenues were flat year over year, their profits are up. So they made $312 million of net income last year, or in last third quarter, and this third quarter they made $582 million of net income. So they almost doubled their profits. So even though revenue is flat, they're operating more profitably. Awesome. Love to see that. Love to see that. Okay, let's look at the spreadsheet. On is, I think, somewhere in the middle. Let me find them here. onsemi right here. We'll put them at the top. What I like is they don't spend a ton on R&D. Look at that, only 14% of their gross profit is being used to R&D. So that tells me that they have a nice advantage that they can keep. Their price to annualized sales is less than 4. That's quite low for a tech stock. They have a huge annualized revenue number, almost hitting 10 billion. And their margins are around 50%, which is great. Semiconductors, that's kind of what you want to see. ARM, I know we said semiconductors, you should see around 50. ARM is different because they have a different business model where they rely on royalties, and the royalties are essentially pure profits. So don't look at that. But if we look at other ones, we're going to look to see a gross margin around 50%. I think that's great. And like I said, they were able to double their net profits year over year despite having the same revenue. So that tells me that this is a business that can execute very well. And if you're willing to look long term, I think this is a great buy right now. Of the 3 stocks I'm talking about today, this is the one that I think is the most compelling. All right, and let's go on to my surprise stock now. That is Allegro Microsystems. So most of you probably have not heard of Allegro Microsystems. I would not have if I wasn't in the business of analyzing stocks. This is I do this YouTube channel for fun, but my full-time job, I do work in finance. So Allegro Microsystems, it's not a very sexy business. What they do is make sensors, what are known as ICs or integrated circuits. So this is what they look like, just to show you. This is really not very exciting, not exciting stuff. But when you think about what needs sensors, it's really pretty much all forms of technology in some way, shape, or form need sensors. So vehicles need sensors to see what's around them. You know, if you have even something as simple as a blind spot monitor, something that if you're about to turn into a lane and there's something in your blind spot, it'll beep at you. That uses sensors. LiDAR uses sensors, autonomous driving. So and EVs. So Allegro is seeing a huge EV boom because, again, just like these sensors that Allegro makes are used in EVs. But this is not just an EV stock. So down here, this is from their website. This is a list of all the applications. So we see automotive is the top one, right? That's probably where most of their revenue comes from. But industrial, look, we can sense it, we can move it. Our complete portfolio of products enables intelligent motion in industrial applications, right? That's the robotics piece. Consumer, from gaming consoles to robotic vacuums, right? I mean, your Roomba needs to sense what's around it in order to move. That's going to be an application. So we see robotics, we see EVs, autonomous driving, and look at this, even energy. So Allegro is definitely dependent on EVs, but is not solely dependent on EVs. So let's look at their financials. So Allegro had this crazy massive rally because their sensors are also used in, well, not their sensors, I should say, but their IC products are used in data centers. So when we saw all that AI hype, I mean, the stock, what was this, April to July? From April to July, the stock rallied almost 50% for no reason, really. And so then we saw it came back down to earth, and then it went way less than down to earth because we saw that softening demand of EVs. So, let's see down here. Okay, so here's the revenues. We see just like they're very profitable, right? They're operating at a profit, and that profit is increasing year over year. So last year, profit of 50 million, now 65 million, even though revenue is only going up about 16%. We like to see that that's in the double digits, though. I mean, don't get me wrong. That's very nice that that's in the double digits. And balance sheet, look at this, just an amazing balance sheet. They have 370 million in cash and only 186 million in debt. So if they wanted to, they could pay off all their debt and still have a good chunk of cash to keep running the business because, again, they're profitable. So they are operating at a profit. So every quarter that goes by, their cash is going up, given that they don't do buybacks or they don't pay a dividend or anything. They don't pay a dividend right now. So Allegro, I think, also looks compelling. My concern with Allegro is, I guess I have a couple concerns. So my main concern is their moat, which remains to be seen. I'm wondering what's stopping other companies. Like, this is such a profitable business. What's stopping other companies from taking market share? But also, since it's such a niche product, I wonder, I wonder if they're going to start to become reliant on one sector like EVs, because they have all these applications, but that remains to be seen. So these are just my concerns. I try to be critical of these stocks, but really this does look really, really nice. So we see gross margins 56%. That's better than On. We see annualized revenue just hit $1 billion. I'd like for that to be higher. This is a small company, market cap of only $5 billion. I try to invest more in larger companies only because smaller companies can be more volatile, and I don't really love volatility. I like to invest in something, and I know that it's going to, to help me sleep at night. But we see a low valuation, price to annualized sales of 4.6 with that double-digit revenue growth, but we need to keep in mind that they're forecasting a slowdown in growth just like everything else. So ON's has already hit, Allegro's is still to hit with that slowdown in growth. So the reason I said I like On more than Allegro is because On has a lower valuation, is a larger company, and even though their growth is slowing right now, I think when they return, they're going to be the leader and they're going to benefit from economies of scale. So I think it's almost a toss-up, like Allegro and On are neck and neck for me, but if I had to pick only one, I would pick On. But if you were looking, for maybe something that was a little bit more high risk, high reward, I think Allegro is your way to go. And at the end of the day, you can't beat Tesla from an EV manufacturer point of view. So what do you guys think? Were these new stocks for you, Allegro and On at least? Is there something else you want to see me cover? Let me know in the comments and I'll get to it as soon as I can. I love when you guys suggest things for me to cover. So anyway, thank you for watching and have a great day.